Welcome to this explainer. Look, if you're running a non-deposit taking Sacco, you already know that Part 7 of the 2020 Sacco Society's regulations is, well, it's a bit of a beast. But today, we're cutting through the dense legal text. We are breaking down exactly what you need to know for absolute compliance and rock-solid financial management. So, ask yourself right now, is your Sacco's credit management actually genuinely compliant? It is the one question that should be keeping every Sacco executive on their toes. If you aren't 100% sure, pay close attention, because the regulations we're unpacking today leave absolutely zero room for guesswork. And here's exactly why you can't afford to guess. 100,000 shillings? That's the heavy, out-of-pocket penalty you could face personally as an officer for violating key regulations. If you flout borrowing limits, launch unapproved products, or play fast and loose with insider lending, this penalty drops squarely on you. The stakes are incredibly high. To make this whole framework digestible, we're going to navigate a roadmap made up of 6 key pillars: the foundations of your credit policy, member rights, lending limits, insider lending, foreclosures, and finally, your overall compliance roadmap. All right, let's jump right into Pillar 1, the absolute foundations of your credit policy. Listen, Regulation 28 is monumental. It requires every single non-deposit taking Sacco to have a comprehensive written credit policy. Think of it as your ultimate operational blueprint. You've got to clearly map out the duties of your credit and technical committees, establish rock-solid loaning procedures, and define strict eligibility criteria. It goes even further, mandating minimum due diligence like property searches, rigorous borrower appraisals, insider lending terms, and exactly how you handle foreclosure disposals. And your credit committee? They are legally bound to keep this massive framework up to date. Moving right along to Pillar 2, transparency and member rights. The days of operating in the shadows are completely over. Regulation 28 mandates a full 60 days written notice if you plan to change any term in a member's loan contract. Furthermore, under Regulation 38, if you reject a loan, you have exactly 14 days to communicate the specific reasons in writing. It's all about keeping your members fully empowered and preventing arbitrary behind-closed-doors decisions. Now let's talk reporting, because the authority is watching closely. On a macro level, under Regulation 29, you must report highly specific sectoral data every quarter. We're talking member IDs, economic sectors, and loan purposes. But internally, the scrutiny is even tighter. Under Regulation 36, by the 15th of every single month, you have to submit a performance report on any loans given to directors or employees. So, the authority is monitoring both macro trends and internal risks simultaneously. Which brings us to Pillar 3, lending and borrowing limits. Here is a hard line you absolutely do not want to cross. Under Regulation 35, a Sacco cannot borrow externally in excess of 25% of its total assets. That 25% is an unyielding ceiling. The only way around this is to secure explicit written permission from the authority for exceptional circumstances. And even then, those funds can only be used to fuel your loan portfolio, never for operational expenses. But what if you want to borrow from another Sacco to cover a temporary liquidity crunch? Well, Regulation 33 dictates that an informal handshake just won't cut it. You must get written approval from the authority. You also need formal board approval, a written agreement, and when you on-lend those funds to members, you have to accurately price those loans based on your operating expenses, portfolio quality, and capital requirements. And before you introduce any flashy new loan product, you've got to follow these 3 exact steps under Regulation 34. Step 1, conduct a thorough feasibility study to establish demand and risks. Step 2, apply for the authority's formal green light. Step 3, only after getting that approval can the board roll it out to the members. Remember that 100,000 shilling personal penalty? Skip this process, and that's exactly what you'll be paying. Let's tackle Pillar 4, navigating insider lending. This is a big one. Regulation 36 puts a very tight leash on insider loans. We're talking about aggregate loans to directors, employees, their immediate families, and business associates. All of those combined can never, ever exceed a maximum of just 10% of your gross loan portfolio. That is your absolute maximum allowable exposure to insiders, period. It's also vital to remember the golden rules here. The law is uncompromising when it comes to preventing conflicts of interest. Insiders get zero special treatment, no favorable rates or terms compared to regular members. Crucially, if a board member applies for a loan, they literally have to walk out of the room during the approval process. Finally, officers and their families are strictly banned from purchasing any of the Sacco's foreclosed assets. Let's shift gears to Pillar 5, foreclosures and debt collection. Meet the foreclosure clock under Regulation 37. Spoiler alert, it's incredibly unforgiving. If you end up holding a member's asset to satisfy a debt, the clock starts ticking immediately. You have a strict 12-month legal deadline to dispose of that asset. If you fail to sell it, you have to start provisioning for probable loss at a painful 25% per annum. And hey, if you do sell it and the proceeds exceed the debt, you must return that excess cash straight to the member. When you're chasing down unpaid debts, Regulation 31 states you must first recover the accrued interest before applying payments to the principal. But there is a massive safeguard for the borrower here. The delinquent interest you recover can never exceed the outstanding principal amount at the time of delinquency. Also, you can't levy extra late fees if the only thing delinquent on the account is previous late fees. And bringing in a debt collector, that can only happen after you've exhausted all normal collection procedures. Finally, we reach Pillar 6, your compliance roadmap. This entire framework we've walked through isn't just some boring checklist to avoid fines. It is your definitive roadmap to building a resilient, transparent Sacco. But it leaves us with one final, provocative question to ponder. If a regulator walked in for a surprise audit tomorrow, would your internal policies actually hold up to the crushing weight of Regulation 28? We hope this explainer brought you valuable clarity. For specialized consulting on these matters and to see how this roadmap fits your organization, please reach out directly at 01071 9089.